Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP, president and founder of TJ Stearns, Inc., giving us guidance and perspective on the financial world, helping to uncomplicate those difficult decisions with our money, with our investments for our financial future. And Tim, we always appreciate the time and the guidance that you provide here on Protect and Grow. Thank you for being here as the resource.
Great, Peter, to be here, and looking forward to getting into today, talking a lot about a lot of things, running out of money, market volatility, all those things that are very important and probably at the front of everyone's mind who's about to retire or is retired.
Yeah, I would have to imagine, Tim, that those you listed, running out of money, market volatility, maybe inflation and interest rates and healthcare, those are like the top areas of concern that I imagine you hear questions about most often.
Yes. So market volatility, let's lead off with that. Basically, you know, the market has been very choppy. I see a lot of people are recircling back to us, coming back saying, oh my gosh, you know, we should have talked to you sooner. The good news is our clients that are here, we're taking good care of them. But as far as people who have not called the show or have called the show and not acted on what we presented them, a lot of them are coming back to the table because they realize that being active money managers like we are in the market, it usually bodes well for both parties, that we can get them in and out of the market. We're not going to be perfect. I've never said that, but we will do better than the rank and file mutual funds. And for those do-it-yourselfers out there, they're starting to realize that it's hard, very hard to make money in a bear market unless you know what you're doing.
Tim, we all enjoy and appreciate when the market's going up, and we are taught, it is told and stated that there is both reward potential and risk associated with investing. So why is it that we're so surprised and caught off guard anytime the market does go down?
Well, I'll take you back to 2008. The market crashed heavily and it killed a lot of people's portfolios. And what'd they say then? Well, you know what, if I ever get so greedy, I'll never let that happen to me again. You know, if my portfolio gets back to X, Y, and Z, I will never do that to myself again. I'll pull the ripcord and get out. And what happened was we had about a 13-year bull market, and people get lazy and they get forgetful and they don't want to look that markets usually correct every 7 years. We're on a 13-year binge of bull market, which is outstanding, but you start to forget the fundamentals. You know, you start getting sloppy, you start getting greedy. And those are the problems that lead to your portfolio taking a hit. And I'll say this again, I had a teacher when I was at DePaul getting my certified financial planning practitioner degree. And basically what he said was, you know what a bull market dies on? Euphoria. And that's where we were in December of 2021. No one thought anything bad could happen in the market. All was well and good. And now the roosters have come home. And now we need to take care of what we've made and try to keep it.
I'm going to remind you listeners and viewers, ladies and gentlemen, if you have questions or concerns about your money specifically, about your portfolio, your investments, your plan for your financial future and retirement, that Tim Stearns is a resource not only here on the program, but to you personally And individually, if you would like to review and evaluate your current portfolio, if you've got questions or concerns that you would like to put together that protect and grow plan, Tim does offer that with no cost and no obligation. A few quick questions over the phone, a longer conversation, an individual specific consultation with a CFP certified financial planning professional practitioner. Tim Stearns, CFP, makes that time available to you. No cost, no obligation. Pick up the phone and give a call. 800-640-2256. That's 800-640-2256. 800-640-2256. Tim, we had experienced such a phenomenal run in the market, really since 2009 through the end of 2021. Fantastic period of time. What factors have led to this recent resurgence in volatility?
Well, there's numerous ones. The government giving out free money, that was one of them. Obviously, the Fed had to stop that because inflation went on a holy tear. I'm 50 years old, and it's the highest it's been since I was 10 years old. So in 40 years, this is the highest we've ever seen. Okay, so that's one reason that inflation has killed the market. When the Federal Reserve starts to tighten money, which means that they're raising interest rates, that never bodes well for the stock market. And they said that they're going to do that through the beginning of next year. So I think the market is going to be a rough road. And so you have to be careful what you have and what you don't have in your portfolio. Most of the portfolios that we're seeing come in from this radio show or our retirement classes they all have correlated assets. With the exceptions of cash, they have bonds and stocks that have all taken a huge hit because of the markets going down. That's one of the reasons that has happened is the rising inflation. The second one, definitely the Ukraine has affected us. I mean, have you gassed up lately? People are paying higher and higher fees at the gas station, and that has some of it to do with it. So the markets are very choppy right now, and you have to have your head on a swivel. It's not a buy and hold environment. It hasn't been for 22 years. We keep forgetting that. And so I'm telling people, make sure that you should have stop losses. You should have some products that are not correlated to the assets that you already have. If you're over 59.5, ask your HR department, your human resource department, can I take my money out and put it into an IRA and open myself up to better offerings than what we currently have in these mutual funds have been losing this entire year for me. I've worked hard for my money. I want to make sure I can take better care of it.
Well, again, if you have concerns, worries, if you would like to look over and review the risks that you're taking and how you are currently allocated, is that the best way to help your dollars work hard toward achieving your future financial goals? Talk with a certified financial planning professional. Talk with Tim Stearns, CFP. You can do so no cost, no obligation. He can run those reports, run the reviews, the analysis of the portfolio, show you the risk that you're taking, the fees that you're paying, and how your current portfolio allocation may be in alignment or misalignment with your goals, and then how to put things in place like stop losses as part of your ongoing plan. 800-640-2256. That's 800-640-2256. 800-640-2256. Tim, I know you're not a fortune teller. Standard issue financial planning crystal ball broke a long time ago, but what do you see ahead? Are things going to get better, or are we going to have it be at least a little less worse, or are we still going to see some challenges moving forward in your opinion?
Well, a year ago, if you had told me the Fed had already raised rates 1.25%, I would have told you you were crazy. And now they're saying that they need more because inflation, it hasn't curbed it by them raising.
Yeah, I think they were surprised that has not started to work effectively. I mean, they were thinking lower inflation for the month of June, and that came in at what, 9.1%, Tim?
Right. And so you look at for every 1% that the Fed raises interest rates, the bond portfolios on average will go down 9%. For every 2%, well, you do the math, that's 18%. It's not an if, it's a when. So you have to be careful when you have interest rate risk and you don't realize it. Interest rate risk is really simple to understand. If a year ago you had a bond at 3% and the Fed has raised interest rates 1.25%, then you're looking at new bonds coming out at 4.25%. Well, who wants your 3% bond? So you have to entice people to buy it by selling it what they call a loss. And everyone has had this happen since 2008, and it's like history is repeating itself. And you wonder, how silly are we? And I even use the word stupid to not realize that this is going to happen. So we need to be more careful with what we're putting into our portfolios, especially IRA money. If you're in your 60s, when are you going to get that money back? In most cases, you're kind of winding it down if you haven't already, and you have to make sure that you keep what you have. Well, what are you doing for that? You can even put stop losses on bond portfolios. We do that. These are the things that we do to make sure that our clients and everyone out there that we're working with, it curbs the losses, and that's huge.
Tim, I know that another one of the big areas of concern, one of the most frequent concerns and fears with our money is running out of it. But I also know that Protect and Grow written retirement income plan specifically addresses this area of concern. How do we go about addressing that fear of and prevent the reality of running out of money?
Well, a good way to get rid of that fear is to have an income allocation plan. Right now we don't have a lot of panicky phone calls coming in because our clients know that they have enough money to pay the bills this month, and we have planned for that. They also have a liquid side that we can pull from if they need the money. But in most cases, a lot of people are batting down the hatches. They're making sure that, yeah, we're paying our bills. Maybe we're not going to take that trip because, their portfolios have taken a little bit of a hit. But at the end of the day, we've been doing much better than the averages, and they're still paying their bills. And I think that's what people want us to work with them.
A specific written retirement income plan, Tim, studies have shown is missing from a majority of even already retired individuals. Yep. Total plan. And then studies have also shown that this fear of running out of money is one of the most prevalent fears that we have. Do you think that those two happen to be correlated?
Yeah, just a little bit. I mean, 1 out of 10 Americans have a written income plan, and of the 1 out of 10, they have some, maybe something on the back of a napkin. We actually do a plan, and we run it out 30 years to make sure that we have it, we take care of inflation. We take care of when they should pull down their social securities if they're married, those types of things are all baked into what we're doing, and it doesn't take any obligation on someone if they want us to do that for them. We're happy to help because it'll point out to them where the pressure points are, where they're going to get hurt if they don't make better decisions.
Again, if you would like that written, Protect and Grow retirement income plan, pick up the phone. That is part of the service and the process there at TJ Stearns Inc. And you can sit down with a certified financial planning professional, Tim Stearns, CFP, to structure that plan, to implement that plan, to understand the benefits of having a written retirement income plan that shows you specifically how to generate the cash flow to support the lifestyle, the comfort and confidence into and throughout retirement. 800-640-2256. That's 800-640-2256. Tim, you mentioned it, and it's another of the, I think, currently large areas of concern. Inflation. We've experienced much more than our desired level of price increases over the last couple of years. How do we structure a plan? How do we deal with and address this issue of inflation?
Well, the only place you can get ahead of inflation, I even tell this to my 93-year-old mother, is to have your money in equities. All right. That being said, go into portfolios that have stop losses or, are watching for volatility, that are going to be active, dynamic, and strategic. If you're doing this buy and hold stuff, it does not work. We call that your grandfather's stock market. 1980 through 1999, that would work, the buy and hold. And that's when that became in vogue, right? The Vanguards out there, that's what they would do. Well, guess what? Many of these companies now, even Vanguard is buying companies that do active trading because they know to get an alpha and an advantage, then they need to have more active stock portfolios, and the proof is in the pudding. The results are much better than the averages because you have to have your head on a swivel in this type of stock market.
Can prices continue to go up the same way that we've been seeing over the past year, Tim?
I believe that, at some point they're going to be stymied by this. You got a lot of things happening here. Number one, I think the Fed is going to be able to stymie it. The other thing is I'm hoping the supply chain and that type of thing that is making prices go up are going to kind of settle down. That COVID is starting to become more the norm, unfortunately or fortunately. So these are the things that I think that will help us. So yeah, I think prices for the near term will still continue to go up, but hopefully they will settle down.
Well, we can hope so. I mean, some inflation is good, but this high inflation that we've seen, not necessarily good for anyone. And the Fed does know that. And that's why, Tim, another factor that we're hearing a lot about is increasing interest rates. Good, bad, indifferent. How do increasing interest rates work for savers and investors?
Well, that is one good thing to your point. With CDs, money markets, multi-year guaranteed annuities, all these different things are starting to have better returns. So that is one nice thing. But you do the flip side of that, if you're borrowing money like an Apple computers, that type of thing, it's more expensive for them to get money, right? So they might not be doing the research and production of different products. So it cuts both ways. Also, if you're buying a house, mortgage rates have gone up. So these are the things where it hurts. But if you're a very conservative investor, you can go into CDs for better returns. Multi-year guaranteed annuities are outstanding right now. And then even money markets are paying out better. Savings are still taking a little bit of a lag there to catch up. But, those are the areas that we're seeing.
Tim, there is an old saying in the financial world that history does not repeat, but it often rhymes. And several of the factors that we've talked about already today, inflation, rising interest rates, market volatility, do seem to be reminiscent of the economic environment of the late 1970s and early 1980s. They had hyperinflation. The government battled that by raising interest rates to significantly high levels. They were in the double digits. And as a result, we actually entered into a pretty challenging, prolonged market recession. I think where we are rhyming but not repeating, Tim, is there are some things that are different about today's environment. The average Main Street American back in the early 1980s wasn't really a heavily invested individual. We did not have heavy individual investment really until the prevalence of an adaptation of 401ks. So perhaps this market volatility, this more challenging market that we're experiencing as a result of rising interest rates may be more harmful than it was even back in the late 1970s and early 1980s.
Well, to your point, Peter, I mean, a lot of more people, I mean, even my sons are investing in the stock market. I mean, it's more prevalent, right? You can do it online. You don't have to go into a bricks and mortar and do all that paperwork and that type of thing. With DocuSign, makes everything easy. But at the end of the day, it makes it a little bit more dangerous for us, right? Because we have these access to these funds that can go up and down precipitously, and right now most of them are going down. So where do you hide when the market's free falling? And I'll say this, I think through the first quarter of next year, it's going to be like this. So what are you doing to protect yourself? If you're still going to just do the buy and hold, then I promise you're going to be losing money. And that goes without saying. And I told you this, a company that this one of our new clients was with told him that his account was worth 1.6 million. By the time we met him through this radio show, he was at 1.3. The young advisor, who's only 5 years on the job, so he's never been through a bear market, told him it will go down to 1.1, but by the end of this year, he'll be back up to 1.6 million. And I scoff at that, because why wouldn't you do better for your client? You know, and they have these commercials that they make more money when you make more money. It's a joke. I don't understand that. And
If you can predict that and know that with any level of certainty, then why go through that at all? Why not just sell out at the right time and buy back in at the right time, Tim? The fact that he would proclaim to have that kind of foresight and yet not be reactive, I think speaks volumes.
Well, you know, and again, this is a 5-year quote unquote veteran managing his money. I mean, the kid's just out of diapers trying to manage money. You know, I've lived through 3 bull markets.
Tim, simultaneously, when it comes to being kind of similar conditions, but different variables, back in the 1980s, I think more of us were net savers. So we actually got to take advantage of a rise in interest rates. Whereas today, many of us individually and us US as a country are pretty heavily in debt. Automobile loans, medical bills, credit card debts, the national debt. So rising interest rates is probably also going to be more harmful this time around than maybe what happened in that previous example of these similar conditions.
Yes. I mean, the average American has over 15,000 in credit card debt. All these interest rates are going up, you know, so if you're a buyer of a house, or if you're a credit card debt holder, you're gonna pay more, and that stinks, you know. But if you are a saver and you have some money, you know, the CDs are out there and that type of thing. But we need to be careful and make sure that you know, CDs aren't going to keep up with inflation. So where do you go to hide? Well, be very careful about where you're investing your money. Make sure that they have stop losses. If they don't, shame on them. Give us a call, and we'll be happy to take you through our process and show you what we're talking about.
800-640-2256, 800-640-2256 to reach Tim Stearns, CFP, and the team from TJ Stearns, Inc. We are talking about some of the biggest areas of concern currently in our financial lives in the economic world. Tim, one of the biggest issues is the potential cost of care, which can be astronomical. How do we begin to address medical expenses and healthcare?
Well, what they're saying around here is it's around $250 to $300 a day for skilled care. So that's in the Chicagoland area. So how do you pay for that? A lot of people think Medicare pays for that. It does not. Medicaid might help you with that, but my Lord, if you would not want your dog to stay in a place that is Medicaid friendly, usually. A lot of these places are not very nice, and that's sad. And that means you have much less assets, and that's how you can tap into that. So what we try to advocate to people is get ahead of it. My wife and I did, you know, we bought life insurance policies that had long-term care components on it. If I cannot do 2 of my activities of daily living, I can pull down on the death benefit of the life insurance policy to take care of myself. And the same for my wife. A lot of my siblings have this as well. So these are the things that, you know, if you're worried about long-term care out there and you don't want to buy a standalone long-term care product because they don't, you know, use it or lose it, these are great products I can leave money to my 3 sons with death benefit that's tax-free. I can borrow against it with the cash value. And then lastly, if I need it for long-term care, to me, I feel like I have a permanent disability policy out there. You know, it's a permanent policy that I can tap into. If I'm 80 or if I'm 50, I can take money out of it.
Well, again, I think the general approach, Tim, is to ignore this issue. It remains that unaddressable 800-pound gorilla in the room, and we all would love to believe that we're invincible and it's not going to happen to us. A little bit of Superman complex, if you will, but statistics show otherwise, and that cost of care is something that we absolutely in the planning process need to address. And there are, Tim, it sounds like reasonable solutions in addressing this issue.
Right. I think a lot of people don't realize that the cost isn't that bad, you know, and you have to run through the numbers to make sure that it works. But when you look at the numbers of the other side of it, not having insurance, 7 out of 10 of us are going to need this care, and 9 out of 10 of us don't have that type of insurance of any shape or form. So I don't like my odds. That's why my wife and I got it. And I would tell anyone out there that's questioning whether they need it, give us a call. We'll run through the scenarios with you and what that looks like.
800-640-2256 to reach Tim Stearns, CFP, the team, and the Protect and Grow plan at TJ Stearns, Inc. 800-640-2256. Tim, all of these questions, these big areas of concern, these issues, I think that most people just don't want to have to worry about them. At the end of the day, we want to live with confidence and not concern ourselves with these issues. But the bottom line, the truth of the matter, the cold hard facts are that if you've got a plan in place, that's the best way for you to not have to continually be as concerned with these issues on an ongoing basis.
It makes for a better retirement, correct? I know that I've got an income allocation plan. I can pay my bills regardless of what the market's doing. I can, if I, God forbid, can't do two of my activities, daily living, I can use money from my death benefit of my life insurance policy. I mean, peace of mind is priceless, correct? I mean, that's what I'm looking at. And I don't know why anyone would want it a different way. Trying to wing it in retirement sounds so dangerous and it sounds very discouraging to me.
Well, good information on today's program. But once again, Tim, you make a very valuable special offer to listeners, to the radio program, to viewers of the podcast. Can you again describe what it is that is the next step in that opportunity for individual savers and investors and proactive planners?
Well, if they want to come in, that's one thing, you know, we'll be happy to do. There's no obligation, kind of go over their scenario and what's concerning them. But the other thing we can do is get a book into their hands about income allocation. And it also has information in there about how our money management works that I think is most people love the book. You know, and it's got a lot of good information in it. And I would tell them the first 10 callers with over $1 million, I'll be happy to get the book in their hands. The information's outstanding. My siblings, who are all baby boomers, have used it and read it, and they love it.
Well, again, if you would like that book, Income Allocation, if you would like to ask a few questions of Tim about your financial concerns or worries or your plan for your financial future, if you'd like to get that proprietary Protect and Grow written retirement income plan, pick up the phone and give a call. 800-640-2256. That's 800-640-2256. Tim, always a pleasure. We appreciate the time and the guidance, the perspective on the financial world and these important issues that you provide and talk through with us here on Protect and Grow Chicagoland Retirement.
Thanks, Peter.
Tune into Chicagoland Certified Financial Planner Tim Stearns' full radio program on 890 WLS every Sunday at 11 a.m. and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.